Welcome to the Ask Faleskini podcast with a guest. I'm proud to present Simon. Simon is our expert for gold. This is the third time he's on our podcast, but in this time it is a must to have a gold expert because the prices are going sky high and crazy, and we're all interested if this is going to last and what will trigger the fall of the prices. And Simon, welcome to the show.
Great to be here. Thank you very much.
So let's address the elephant in the room. Is price going up or down?
Well, the prices, I think volatile is probably the best way of describing it. It has been going up. This week it's sort of been going down a bit. But I think I'll get into what I view as the main drivers of the gold price in a second. But there's some big data due out of the US in terms of inflation. And I think that the last read was 2.9%. So I think if that number is higher than 2.9%, I can see the gold price going up. If it's lower, I can see the gold price going down. And if it's pretty much on 2.9, I don't think the gold price will move that much. But it's certainly an interesting number that's due to come out of the US.
So we're all waiting for the biggest economy to show the results, and then we will know how to in which direction the gold price will go. But let's assume the worst case scenario and the price go down. I believe that will be also a good time to invest, because we usually invest in gold for the long time. It's not just a asset that we speculate on. It's usually something that we prepare as a part of our liquidity program and as a separate asset class. So the biggest challenge we have with gold usually is where can we store it and how can we transport it? Can we talk a little bit about that?
Yeah, I mean, there's a massive misconception that gold is really for the rich and you need to buy a lot of it. That's simply not true. You can buy, I think, a quarter sovereign coin in the UK is about £200. I'm sure you can buy some cheap coins in Europe. You could buy silver, which I think you can get for closer to £50 of silver Britannia. And if you do decide to buy some gold, you don't necessarily have to take delivery of it. You can get it stored and insured. You obviously need to check that with your dealer first, but you probably find that they can store and insure it, which shouldn't cost you much. It'll probably cost you 0.3 to 0.5% of the amount you bought. So it's a great facility to have. And I think the other thing I'd add to that is that you find with some dealers that they can not only store and insure it for you, but if you want to sell it back to them, it's never left their premises. So they're happy to buy it back from you. So it can be a very efficient way of essentially holding cash in gold. And if you need cash quickly, you can sell gold instantaneously. It's priced every second, let alone every day. And so you can basically sell your gold, get the cash in your account very quickly. So it can be a very good cash management tool as well.
Okay, we had a brief conversation before this recording started about investing in jewelry, and you gave me really good advice what kind of jewelry we should buy. Can we please discuss this topic? Because as for mobility or being able to transport it, jewelry is usually very convenient for smaller quantities, of course.
Yeah, no, absolutely. I mean, I think jewelry makes a lot of sense, as you say, in smaller quantities. The thing you need to remember about jewelry is that a lot depends on the brand that you're buying. So if you're buying it, let's say, from your high street shop or somewhere that's not branded, you'll probably find the margin on it is, let's say, 20%. But if you're buying a high-end branded piece of jewelry, I'm guessing something like, I don't know, Cartier or something like that, you probably find the margin is significantly higher. And so in that case, you're buying partly because of the brand, or a significant part of what you're buying is a brand. Whereas if you're buying it from your high street, you probably find a significant part of what you're paying for is actually the gold value. So if you're going to be buying jewelry, that's something to bear in mind. What do if you really know what you're doing, then and you're buying it because of, let's say, brand power, then I'm sure some of these big brands are definitely worth having because they've got global recognition. But if you're just looking to get the gold value, then you may want to be looking more at your high street store.
Thank you. So basically, if you're looking at gold as potential investment or thing that that can be highly liquid, so that you can sell in a pawn shop or your local jewelry, then buy from local shop that has smaller margins, and with a small increase in price, what you have paid for, you will be able to sell it if that is needed in the future. What about investing in gold as part of our pension plan? Can we discuss that a bit? Right now, especially Robert Kiyosaki is all about gold, gold, gold. And what can we tell typical midlifer about pension and gold? How should we go about it if we want to make it part of our pension plan?
Yeah, I mean, I think gold is a fantastic asset for pensions for various reasons. In the UK, and you need to check the rules of wherever you're domiciled, but in the UK, if you buy gold of a certain purity and have it for investment cases, which you probably do with a pension, then you can hold it in your pension, and you don't pay capital gains tax on the increase in value. So it can be a very tax efficient way of holding gold. I think also I'd add, when you retire, again, it's very liquid. So if you need cash quickly, then hopefully your gold's gone up in value, and you can quickly liquidate it. Which you may find other assets in your pension, such as property or private equity or whatever, are more difficult to liquidate. So I think it can be a very useful asset to have in your pension.
Okay, and now let's move from let's say everyday people to people that are already putting together their investment portfolio and are a bit more advanced. Can we discuss gold as an asset class, and why exposure to gold is a huge opportunity, and how it can act not just as a potential liquidity provider, but also hedge against other market uncertainties?
Yeah, well, I think first up, gold doesn't correlate. When I say correlate, doesn't move, the price doesn't move that closely with a lot of other assets. And so it's a good diversifier in your portfolio. It's often viewed as an inflation hedge. There's an element of truth in that. If you look at the increase in price in gold over the last 25 years, it's been significantly ahead of inflation. But I'd caveat that with the gold price goes up and down, whereas inflation only tends to go up. So you could actually buy gold and the price has gone down, but inflation's gone up, in which case it's not inflation hedge. But I think most people, or a lot of people, view it as a good way of trying to protect themselves from inflation. And I think that's particularly relevant actually with people who, let's say, are holding a lot of cash, because back in the day, going to cash was perfectly sensible because inflation was very low. And so, yes, you would probably lose uh, 2% of your purchasing power. If the rate you got was, let's say you got 1% and inflation was running at 2.5%, you're probably losing 1.5%. And you kind of like, you could live with that, because you could probably still buy the asset you wanted to buy in 2-3 years' time. Let's say you're saving up for a car or a house or something. But inflation starts to really move, and the gap between what you can get with your cash on deposit, let's say it's 4%, but let's say inflation goes to 8%, then you've got a 4% gap. And so you're less certain as to what you can actually buy with the cash that you've got in 2 or 3 years' time. And so it's really a matter of what you're prepared to pay for that certainty. And it's kind of moving things on its head a bit, because the gold price goes up and down. So you can say to someone, look, we'll take your £1 now, but we don't know what that £1 will get in 3 years' time, but it may actually get you what you want plus a bit more. Or we'll take you £1, we'll tell you what you'll have in 3 years' time, but we've got no idea what that'll buy. So it's kind of, it messes with people's heads a bit in terms of what they can buy and what the price will be. And is it a risk? Yes, of course it's a risk. But if you look at it over the longer term, the gold price has performed pretty well. And so I think for a lot of people, it's a risk worth taking.
Yeah, I would also like to stress what you mentioned before we started the recording. You shouldn't put all your eggs in one basket. So gold is exposing you to certain stability, to certain, let's say, liquidity, but it does not solve all your problems. So if you have cash reserves, or if you have a diversified portfolio with shares and other assets and property and other assets inside, gold should be just a part of that portfolio. So Simon is never advocating that you should put everything on gold.
Yeah, no, I think that's very true. I think it's part of the solution, but it's not the solution. And I don't think any asset class is the solution. But we talk about gold in our everyday language. They've been as good as gold. I don't want them to marry a gold digger. Looking forward to my golden years. I want to win that gold medal. But if you actually speak to someone and say, "Well, do you have any gold?" They're like, "No." And my mission is really to change that. And that's what I have with my gold program. I try and teach people how to get exposure to gold. And I'm not saying they should put all their money in gold, but having some exposure to gold, I think, could be massively beneficial to people.
Simon, can we mention or talk a bit about your program, how to invest in gold, and how can our listeners and viewers reach out and learn more about investing in gold?
No, thank you. I mean, basically, because it's a new asset class for people, I find a lot of people, they need help. And there's lots of different ways you can invest in gold. And I have a system that I use that I regularly post the performance of. And in less than 3 months, I picked 2 random portfolios using my system. One did 42.4%, one did 42.2% in less than 3 months. And what I say to people is I use a fantasy football format. So I've got a stadium and a training ground, which stadium is physical, training ground is funds. And then I've got goalkeeper, defender, midfielder, forwards. And I help people build a portfolio. And the whole idea is, they do the course, which is really easy. I show them how to put the system together, and they build a portfolio, and in the nicest possible way, they kind of forget about it. And then is it exposed to the gold price? Of course it is. But the whole idea of it is not just exposed to the gold price. Those numbers I gave you, the 42.4 and 42.2, I think the gold price has gone up about 28%. So yes, the gold price is very relevant to the portfolio. But the whole idea is, you invest in companies that perhaps have got exposure to other commodities as well. They're in different countries and different currencies and a whole load of things. So you're getting very broad exposure, not just to gold, but to sort of the gold world, for want of a better term. And that's really the driver of the course. And I've got an offer out at the moment, actually, that if the system doesn't generate 11% at some point in a year from both the portfolios, not just one, but both, then you get the cost of the course back. And, I'm very relaxed about that. So say it's at 42.4 and 42.2 in less than 3 months. So I'm very relaxed about 11% as part of the offer. But yeah, it's certainly an interesting area for people to look at.
Okay. I will include the links below. And Simon, thank you very much for your insights. And looking forward for our next interview in about half a year.
No, that's great. It's certainly a good time. And as I say, look at that inflation number, see what it comes out with.
Thank you.
Thank you very much.